Hey everybody, Derek Bissen here, and today's topic is reserves. Reserves is an important part of loan approval. In fact, in many cases, you could argue that it's more important than your credit score. In this video, we're going to break the whole thing down to keep it super simple for you. Before we jump in, quick plug for the channel. If you like this sort of content and you want to learn more about this type of stuff, be sure to hit all those buttons. You know what to do. To put it simply, reserves are simply the amount of money that you have left over after you buy the home, after you paid your down payment and settlement charges for the home. It tells the lender how long you'd be able to continue making your bills if you suddenly lost your income. During the approval process, the lender will request all of your bank statements and then they'll add up all those balances. Then they're going to back out the down payment and settlement charges for your transaction, and then that's going to tell them how much money you have left over. Lenders refer to your reserves in terms of the number of months of reserves you have. So it's common for a lender to say, this applicant has X amount of reserves left over each month. So what that basically means is we take your total monthly payment. That includes principal, interest, your property taxes, your homeowner's insurance, and any association dues that are affiliated with the house. In other words, the total amount of housing cost for that home. And then that becomes 1 month of reserves. All right, so then we're going to take how much money you had left over after the transaction, and then we're going to divide by that number. If your total savings was $10,000 after you bought the home and your monthly payment was $2,500 a month, we would say that you had 4 months of reserves. Now, if you're applying for a new primary residence, but you also have a vacation home and maybe an investment home or two, this can sometimes get more complicated, especially for traditional loan programs like conventional loans. And those types of approvals, you might have to show that you have a certain number of months for your second home or vacation home, and then as well as a certain number of months of reserves for your investment properties per property. Reserves can become a more important part of your loan approval process if you're qualifying for a non-traditional loan program, an unconventional loan, such as a bank statement loan, a 1099 loan, a profit and loss statement loan, etc. For these types of loan programs, you can see a minimum requirement of either 3 months of reserves all the way up to 12 months, and that's usually dependent upon your credit score and your down payment. Thing is, most people who are on the internet watching videos like this, by the time you go to apply for a home loan, you probably have a pretty good idea of what your credit score is, but very few people coming in the door generally know what their reserves are or the reserve requirements for the loan, which kind of underscores the importance of finding a loan originator who understands the type of lending program that you need. And now that you know how to calculate your own reserves, that should give you more confidence when you apply for your next home loan. And that's it for today's video. If you have questions, be sure to leave a comment in the description below, and we'll be sure to get back with you. And remember, if you're looking to purchase, refinance, or get pre-approved to purchase your next dream home using a traditional or non-traditional loan, we would love the opportunity to assist you. Thanks again for watching. I'm Derek Bissen, and this is Unconventional Lending.